As of late 2025, COMEX registered silver stands at approximately 35 to 40 million ounces, down from over 100 million ounces in 2020. That's a 60 to 65% decline in 5 years. Total COMEX silver, registered plus eligible, is approximately 280 to 300 million ounces, down from 350 to 380 million in 2020. The London Bullion Market, which handles the majority of global wholesale silver trading, doesn't publish inventory data as transparently as COMEX, but industry sources indicate London vaults have seen similar drawdowns, with available silver declining 20 to 30% since 2020. Silver-backed ETFs, particularly SLV, iShares Silver Trust, and PSLV, Sprott Physical Silver Trust, hold approximately 550 to 600 million ounces combined. These holdings have been relatively stable, but that's because ETF investors are holding, not because supply is abundant. If ETF redemptions accelerate, investors selling shares to cash out, those funds would need to liquidate physical silver to meet redemptions. That would add supply. But if investment demand continues rising, ETF inflows would absorb even more physical silver, tightening the market further. The invisible inventories are harder to track. Industrial users typically maintain 3 to 6 months of silver inventory to ensure production continuity. But with delivery times extending and supply uncertainty growing, some industrial users are increasing inventories to 6 to 12 months. That locks up silver that would otherwise be available for other buyers. Dealer inventories, the silver that online bullion dealers and coin shops keep in stock, are at historic lows. Multiple dealers have reported inventory levels at the lowest since 2020, and some smaller dealers are struggling to source product at any price. The net effect is this: 7 years of supply deficits have drained approximately 500 to 700 million ounces from above-ground stockpiles. What remains is increasingly concentrated in ETFs and long-term holdings that aren't coming to market. The free float, silver available for purchase at reasonable premiums, is shrinking rapidly. The price response? Why, $35 is just the beginning. So we have constrained supply, mining production flat, refining at capacity maxed out, recycling insufficient. We have surging demand, industrial consumption accelerating, investment demand rising, government accumulation increasing, and we have depleting inventories. 7 consecutive years of deficits draining stockpiles. This is why silver hit 35 per ounce in December 2025. And this is why many analysts believe we are in the early stages of a much larger move. Let's put current prices in context. Silver peaked at $49.45 in January 1980 during the Hunt brothers' attempt to corner the market. Adjusted for inflation, that's approximately $180 in 2025 dollars. Silver peaked again at $48.70 in April 2011 during the post-financial crisis commodity boom. Inflation adjusted, that's roughly $65 to $70 in 2025 dollars. At $35 per ounce, silver is below its inflation-adjusted historical highs. And the supply-demand fundamentals today are arguably tighter than in 1980 or 2011. In 1980, industrial demand was minimal. Silver was primarily monetary. Today, industrial applications consume 60% of supply. That demand is inelastic. Solar panel manufacturers can't substitute another metal for silver paste. EV makers can't replace silver in electrical systems without significant cost and performance penalties. The gold to silver ratio currently sits at approximately 77.1, meaning it takes 77 ounces of silver to buy 1 ounce of gold. Historically, this ratio has averaged 50.1 to 60.1. When the ratio is elevated, it suggests silver is undervalued relative to gold. If the ratio reverts to 60.1 and gold holds at $2,700, silver would trade at $45. If it reverts to 50.1, silver reaches $54. These are mean reversion scenarios, not speculative targets. Some industry analysts have published more aggressive forecasts. Projections range from 50 to 75 $ over the next 12 to 24 months, based on supply constraints alone, before accounting for any potential monetary demand surge if inflation concerns intensify. But here's the critical point. The supply crisis isn't a short-term issue. New mines take 7 to 10 years. New refining capacity takes 3 to 5 years. Industrial demand continues accelerating. This isn't a situation that resolves in 6 months or a year. The structural deficit is locked in through 2027 at minimum, possibly longer. What this means. Going forward, the silver supply crisis is real, measurable, and accelerating. Mining production cannot increase quickly. Refining capacity is maxed out. Industrial demand is exploding from solar, EVs, and AI. Above-ground inventories are depleting after 7 consecutive years of deficits. These are not opinions. These are documented facts from industry data. What happens next depends on how quickly demand continues growing versus how fast supply can respond. If solar installations continue at current growth rates, 10 to 20% annually, silver demand from that sector alone could hit 650 to 700 million ounces by 2027, up from 500 to 550 million in 2025. That's an additional 100 to 150 million ounces of demand with no corresponding supply increase. If EV production scales as projected, reaching 25 to 30 million units by 2028, that adds another 50 to 75 million ounces of annual demand. AI infrastructure build-out continues accelerating, adding another 20 to 30 million ounces. Each sector compounds the deficit. On the supply side, even if mining companies started new projects today, those mines won't produce meaningful silver until 2030 to 2032. Refining capacity might expand modestly by 2027 or 2028, but not enough to eliminate bottlenecks. Recycling rates might improve slightly, but the structural constraints remain. The timeline suggests this crisis intensifies before it resolves. Prices at $35 per ounce in December 2025 reflect current supply tightness. If deficits persist through 2026 and 2027, which supply-demand fundamentals strongly suggest, prices will need to rise further to ration demand. How high depends on how much demand destruction occurs. At what price do industrial users reduce consumption, substitute alternatives, or delay projects? For solar panels, there's limited substitution. Manufacturers are already using thinner silver layers. Further reductions compromise efficiency. For EVs, silver is critical for electrical systems. Substitution is difficult without redesigning components. For AI infrastructure, silver is essential for high-performance electrical switching. That means demand is relatively price inelastic. Prices may need to rise significantly, potentially to $50, $60 or higher, before demand destruction occurs at meaningful scale. And by that point, the market psychology shifts. Higher prices attract investment demand, which adds to supply pressure rather than relieving it. This is the pattern we've seen in every commodity supply crisis. Prices rise gradually, then accelerate, as inventories deplete and supply constraints become undeniable. We may be in the early acceleration phase right now. Conclusion: recognizing the pattern, the silver market in 2025 is experiencing a convergence of supply constraints and demand growth that has not occurred in modern commodity history. Mining production constrained by geology and economics. Refining capacity maxed out with no quick expansion path. Industrial demand exploding from technologies that require silver and cannot easily substitute. 7 consecutive years of supply deficits draining inventories to critically low levels. Prices at $35 per ounce reflect this reality. But if the structural deficit persists, and all available data suggests it will, prices have further to rise. This isn't speculation. This is supply and demand reaching an inflection point where the market must reprice to ration limited supply among competing demands. For observers of commodity markets, this is a textbook supply crisis unfolding in real time. The question isn't whether supply is constrained. It demonstrably is. The question is how high prices must rise to bring supply and demand back into balance, and how long that takes. History suggests these crises don't resolve quickly. They build over years, break suddenly, and take years to rebalance. The silver market has been building toward this moment since 2019. The break may be happening now, and the rebalancing could take until 2028 or beyond. This is the silver supply crisis, not a theory. A measurable, documented, accelerating breakdown in the physical supply chain, meeting surging industrial demand. And it's only just beginning. The refining bottleneck, processing capacity. Maxed out. Even when silver ore is mined, it doesn't go directly into products. It needs to be refined, processed from raw material into pure silver bullion, bars, and blanks for coins. And this is where the second bottleneck exists. Global refining capacity is concentrated in a handful of facilities. The major players are Heraeus in Germany, Metalor in Switzerland, Valcambi in Switzerland, Johnson Matthey in the UK, and a few facilities in China and Mexico. Together, they process the vast majority of refined silver globally. And right now, these refiners are operating at or near maximum capacity. When demand for refined silver increases, refiners can't just flip a switch and increase output. Refining requires specialized equipment, trained workers, and significant capital investment to expand. Reports from industry sources indicate that delivery times for refined silver blanks, the raw material mints used to stamp coins, have extended from the usual 2 to 4 weeks to 8 to 12 weeks. That's a tripling of lead times. Why? Because refiners are prioritizing existing customers and struggling to secure enough raw material to process. Here's how the bottleneck works. Miners produce concentrate, or that's been partially processed but isn't pure silver. This concentrate goes to refiners. Refiners purchase concentrate on the spot market or through long-term contracts. When demand for refined silver surges, refiners compete for limited concentrate supply. prices for concentrate rise. Refiners pass those costs forward to mints, industrial users, and dealers. And there's another constraint: energy. Refining silver is energy intensive. It requires high temperatures, chemical processes, and specialized handling. In Europe, where energy costs spiked in 2022 and 2023 due to the Russia-Ukraine situation, refining costs increased dramatically. Some smaller refiners shut down operations temporarily. Others reduced output to manage costs. China is the largest refiner by volume, processing an estimated 200 to 250 million ounces annually. But China has been implementing export restrictions and prioritizing domestic supply for its own industrial needs. Solar panel production, electronics manufacturing, 5G infrastructure. China's internal demand for silver is growing. That means less refined silver available for export to Western markets. The result is a two-tier market. Industrial users with long-term contracts get their refined silver, though at higher prices. Mints and smaller buyers face delays, allocation systems, and premium pricing. And retail buyers at the end of the chain see extended delivery times and spiking premiums. This refining bottleneck cannot be solved quickly. Building a new refining facility takes 3 to 5 years and requires regulatory approval, environmental permitting, and hundreds of millions in capital. No major new refining capacity is coming online in 2025, 2026, or likely 2027. The constraint is locked in. The demand explosion. Industrial consumption accelerating. Now let's look at the demand side. Because while supply is constrained, demand is exploding. And this is the critical driver of the crisis. Silver has over 10,000 industrial applications. It's the best conductor of electricity, the most reflective metal, and has unique antibacterial properties. These characteristics make it irreplaceable in many technologies, and 3 sectors are driving unprecedented demand growth: solar energy, electric vehicles, and artificial intelligence infrastructure. Solar panels use silver paste for electrical conductivity. Each panel contains approximately 20 to 25 grams of silver. That doesn't sound like much until you scale it. Global solar installations in 2024 reached approximately 450 gigawatts. In 2025, that's projected to hit 500 to 550 gigawatts, a 10 to 20% increase. Each gigawatt of solar capacity requires roughly 1 million ounces of silver. That means solar demand alone is consuming 500 to 550 million ounces annually, about 45 to 50% of total mined supply. And solar installations are accelerating, not slowing down. Climate commitments, energy transition policies, and falling panel costs are driving exponential growth. Electric vehicles use 2 to 3 times more silver than internal combustion vehicles. EV batteries, charging systems, and electrical components require approximately 25 to 50 grams of silver per vehicle, compared to 15 to 20 grams in traditional cars. Global EV production in 2024 was approximately 14 million units. In 2025, it's projected to reach 17 to 18 million, a 20% increase. That translates to an additional 150 to 200 tons of silver demand, roughly 5 to 6 million ounces. And then there's AI infrastructure. Data centers require massive amounts of electrical switching, cooling systems, and server components, all of which use silver. The AI boom of 2023 to 2025 has driven unprecedented data center construction. Industry estimates suggest AI-related infrastructure added 30 to 50 million ounces of annual silver demand in 2024, and that's growing as AI deployment scales. Add in 5G telecommunications, medical devices, consumer electronics, and defense applications, and total industrial demand in 2025 is estimated at 700 to 750 million ounces, up from approximately 550 million in 2020. That's a 35% increase in 5 years. Investment demand is also rising. With inflation concerns persisting despite central bank claims of stability, investors are seeking hard assets. Gold is expensive, trading above $2,700 per ounce. It's out of reach for many retail investors. Silver, at $35 per ounce, remains accessible. Reports indicate retail silver investment increased approximately 15 to 20% year over year in 2024, adding another 50 to 75 million ounces of demand. And government stockpiling is increasing. While not widely reported, industry sources suggest several nations, particularly in Asia, are accumulating strategic silver reserves alongside gold. Silver's industrial applications and defense technology make it a strategic commodity, not just a monetary metal. When you add industrial demand, 700 to 750 million ounces, investment demand, 250 to 300 million ounces, and jewelry, silverware, 200 million ounces, total demand in 2025 is approximately 1.15 to 1.225 billion ounces. Total supply from mining, 1 billion ounces, and recycling, 150 to 180 million ounces, is approximately 1.15 to 1.18 billion ounces. That's a deficit. And it's the 7th consecutive year of deficits. Since 2019, the silver market has been consuming more than it produces. That deficit has been filled by drawing down above-ground inventories, stockpiles held in vaults, ETFs, and private reserves. But those inventories are finite, and they're depleting rapidly. The inventory drain, stockpiles running low. The silver market operates on visible and invisible inventories. Visible inventories are tracked. COMEX vaults in New York, London Bullion Market vaults, and silver-backed ETFs like SLV. Invisible inventories are privately held. Industrial stockpiles, dealer inventories, and personal holdings that aren't reported. Let's look at COMEX, the Chicago Mercantile Exchange, where silver futures trade. COMEX maintains vaults, where physical silver backs futures contracts. These vaults hold two categories: registered silver, available for delivery against contracts, and eligible silver, stored but not available for delivery. Silver just crossed $35 per ounce. December 2025, that's a 47% increase year over year, the highest level since 2012. And while everyone's talking about the price, almost nobody's explaining why this is happening. This isn't about speculation. This isn't about market manipulation. This is about something far more fundamental. The physical supply of silver is breaking down at every level of the production chain, and what's happening right now has never happened before in the modern silver market. For the first time in history, we're seeing simultaneous failures at three critical points. Mining production can increase, refining capacity is maxed out, and industrial demand is accelerating faster than supply can respond. The result is a structural deficit that's been building for 7 consecutive years. And in 2025, that deficit just went critical. I'm going to show you exactly what's causing this crisis, layer by layer. The geological constraints that make new silver mines nearly impossible, the refining bottleneck that's choking supply even when ore exists, the industrial demand explosion from solar, EVs, and AI that's consuming silver faster than it can be replaced. And most importantly, the timeline, how long this lasts, and what it means for prices going forward. This isn't financial advice. This is a structural analysis of a commodity market facing constraints that cannot be solved quickly. Let's break it down. The mining problem, why production can't increase. Let's start at the source. Silver comes from the ground, and getting it out of the ground is getting harder, not easier. There are two types of silver mining: primary silver mines, where silver is the main product, and byproduct mining, where silver comes out alongside copper, zinc, and lead. Primary silver mines represent only about 25% of global production. That's roughly 250 million ounces out of approximately 1 billion ounces mined annually. The rest is byproduct. And here's the critical issue. Primary silver mines are facing declining ore grades across the board. An ore grade measures how much silver is in each ton of rock. 30 years ago, high-grade silver deposits might contain 300 to 500 grams per ton. Today, new deposits average 100 to 150 grams per ton. That means miners are processing 3 times as much rock to get the same amount of silver. More rock means more energy, more labor, more equipment, more cost. Fresnillo in Mexico, the world's largest primary silver producer, cut production guidance for 2025 by 8%. Pan American Silver delayed expansion projects, citing permitting issues and capital constraints. These aren't management failures, these are geological realities. The high-grade, easy-to-process deposits are depleted. What remains requires massive capital investment for diminishing returns. And here's where it gets worse. Mining companies make investment decisions based on price signals. When silver was trading at $20 to $25 per ounce for most of the 2010s, new mine development didn't make economic sense. It takes 7 to 10 years to bring a new mine from discovery to production. Companies that should have started projects in 2015 or 2016 didn't, and that means there are no new major silver mines coming online in 2025 or 2026. Now let's talk about byproduct silver. This is 75% of supply, about 750 million ounces annually. It comes primarily from copper, zinc, and lead mines. And here's the fundamental problem. Byproduct silver production is dictated by demand for the base metal, not by silver prices. If copper demand is weak, copper mines don't expand. If zinc prices are depressed, zinc mines don't increase production. And the silver that would have come with expanded base metal mining simply doesn't materialize. This makes silver supply fundamentally inelastic to silver prices. Right now, copper prices are volatile but not surging. Zinc markets are oversupplied. Lead is stable. None of the major base metals are seeing the kind of demand growth that would justify massive new mining projects. BHP, Rio Tinto, Glencore, the major diversified miners, their capital expenditure plans show minimal new projects, with significant silver byproduct coming online before 2028 to 2030. That's 3 to 5 years. The supply constraint is locked in structurally. And then there's the third source, recycling. The silver industry likes to point to recycling as a solution. Urban mining, recovering silver from electronics, solar panels, industrial waste. Except the economics don't work. According to the Silver Institute, recycling rates for electronics are approximately 15 to 20%. That means 80 to 85% of silver used in phones, computers, and devices is never recovered. Why? Because the average smartphone contains about 0.02 to 0.03 grams of silver, worth maybe 2 to 3 cents at current prices. When the cost to extract it is 5 to 10 cents, it doesn't happen. Solar panels are even worse. They lock silver away for 25 to 30 years. And when panels reach end of life, recycling requires specialized facilities that most regions don't have. The majority of decommissioned solar panels get landfilled, not recycled. That silver is effectively removed from supply for decades. Industrial recycling does better, maybe 40 to 50% recovery from manufacturing waste. But industrial processes are constantly optimizing to use less silver, not more. Thrifting, using thinner layers of silver in applications, means there's less waste to recycle. The math is simple. Recycling adds approximately 150 to 180 million ounces to supply annually. Global consumption in 2025 is estimated at 1.2 billion ounces. Recycling covers 12 to 15% of demand. It's not solving the deficit. So primary mines can't increase production due to declining grades and lack of new projects. Byproduct mines won't increase production because base metal demand is flat. Recycling can't scale fast enough to matter. The supply side is constrained structurally and for years to come.